The last year or so has been a very tough time for the United Kingdom, and unfortunately, over the last couple of weeks, it's only gotten worse. We have been suffering from political instability as a new Prime Minister rose and tried to lay her mark on the country, and we then suffered some economic instability as investors all over the world roundly and assuredly laughed at her plans as they decided to short the pound as her plans just seemed very ineffective. Now, this was, of course, heavily covered at the time and for good reason. We almost saw in real time a collapse of billions of dollars worth of pension funds across the UK in what almost definitely would have been a British Lehman moment. In the end, though, the Bank of England intervened and they applied a band-aid onto a sucking chest wound and said everything was okay. Colour me surprised then when just a couple of days ago we got news that the problems are not over and that they are probably only just getting started. Now, last week I put out this video explaining exactly what went on at the time, so I'm only going to briefly recap what actually happened last week for anyone who missed this video. Basically though, our government announced a budget which goes over and details where they will get their taxes from and where they will be spending our money. Now, the name and the game of this particular budget was tax cuts and more spending. The markets were pretty worried about this idea though. They're quite right to be worried as well because inflation is very high in the UK and tax cuts and increased government spending are both likely to be inflationary and increase those levels of inflation in the near future. Essentially, investors all over the world lost faith in the British government over the course of a few days, and so they took their money out of the markets, and a lot of people actually started betting against the pound and other British equities. We saw the pound lose a lot of value against the dollar and fall from about $1.13 to $1.03 at its worst in this dip here, as you can see, before rebounding back up further. Now, at the same time as this happened, we also saw gilt yields, or basically just British government bond yields, rise by a hell of a lot, from around about 3.3% to 4.4% in a single day. And as we all know, when bond yields rise, bond prices fall. What we didn't know at the time though, but what was secretly happening behind the scenes, was that a number of pension funds in the UK saw their assets tank as both the pound had weakened and the gilts that they owned had dropped in value, and so they faced massive amounts of margin calls as they were simply too heavily leveraged. Obviously, a series of margin calls on that larger scale will cause huge amounts of selling pressure, and that can lead to not only a collapse of those affected institutions, but a collapse of the underlying asset prices even further. It turns out that the pension funds had not been sufficiently regulated in regards to their leverage after the 2008 crash, because the focus back then was on mortgages and their derivatives. In order to stop the collapse of these multiple billion-dollar pension funds, the Bank of England intervened in the bond market, turned on the money printer, started back up quantitative easing, and bought about £4 billion worth of bonds to shoot prices up and yields back down and save these pension funds from liquidation. Now, as I said, all of this happened behind the scenes and we just didn't know it was actually happening until a couple of days afterwards. Unfortunately though, as is so often the case, this is just a band-aid and does not fix any of the underlying problems the market was facing. The nature of the government plans are still inflationary and the markets know that, so the market's decision to dump British government debt and send yields rising, that isn't going to change. Now, you can already see this if you look at a chart of gilt yields, as you can see here. They dropped down to this level after the Bank of England initially intervened, but then they just started rising back up as the market pricing takes hold. The Bank of England is once again fighting the markets here and trying to reprice an asset, and the only way to do that is to spend huge amounts of money. The big issue with this is that the Bank of England's own policy is just quantitative easing all over again, which is also inflationary. This whole process will merely cause more inflation in the long run and make everything so much worse. Now, as if that wasn't enough, over the last couple of days, we ended up getting word out proving what we already knew, that this was not a one-time intervention, and that if the Bank of England really wants to fight the markets as they claim, they're going to need to increasingly spend more and more money. They came out with a press release basically announcing just that here. First, the bank will stand ready to increase the size of its daily auctions to ensure there is sufficient capacity for gilt purchases ahead of Friday the 14th. The maximum auction size will be confirmed each morning at 9 AM and will be set at £10 billion in today's operation. That's up from £5 billion over the last week. They also spoke a lot about the temporary expanded collateral repo facility, and while what that first point means is quite obvious, they will be spending more money to fight the markets and will be doubling the capital at their disposal from £5 billion a day to £10 billion. More quantitative easing, that means more inflation in the future. The second point is in regards to ensuring market liquidity, and it involves the Bank of England taking on some risk on behalf of financial institutions and increasing liquidity in the markets in the process. Now, the way this works is quite complicated and is an entire video all on its own once more, but it's a similar thing to the Federal Reserve reverse repo operations, which have garnered loads of attention over recent years for spiraling out of control. Really, what this press release says is that it's more of the same of last week in an attempt to once again reassure investors. The massive, huge, glaring issue with all of this, though, is that it simply isn't working. Despite this announcement, so far the yields on these gilts have not fallen, and they are instead continuing to rise. The only thing the Bank of England can really do here is continue to escalate and spend more and more money. Of course, though, every penny that they spend on this strategy, the stability of the British financial system actually decreases as the chances of future inflation continue to rise because quantitative easing does cause inflation. As a result, the number of investors willing to buy gilts reduces, and essentially this policy that the Bank of England is enabling and enacting right now as we speak is saving the British financial markets from destruction, but it's also creating that very same collapse just further down the line. There is quite literally no easy way out here. One of the largest problems here is that investors and the markets lost faith in the British economy. Inflation is still sky high, that is still the mainstream narrative, and it's accurate, so it's not very easy to forget. And it's also the causes of almost every single problem we see in financial markets today. In that sense, the UK is no different to America or Europe or anywhere else in the world. Of course, we also know how to fight inflation. It's very clear, and there's a very obvious course of action. Take money out of the system and stop putting it in. Raise interest rates to slow down investment in the economy, reduce government spending, and increase government taxation. Basically, grind the economy to a halt. Now, those are unkind words and they're scary ideas, but that is plain and simple how you fight inflation. The UK, though, is going in the opposite direction, and they are fueling the inflation fire with counterproductive policies. Now, to be fair, the UK is not the only country or institution doing this at all, but they are doing it in a most vocal way, and they are getting most of the attention. This directly feeds into confidence about the British economy, and that drives markets. Now, the US government has also been spending more and more money during rising inflation. Biden has been pushing for massive bills to serve one political aim or another, and this will cause more inflation. There are even inflation relief checks going out in almost 20 different states across the United States, which will all cause more inflation. The European Central Bank has also started back up quantitative easing, buying Italian bonds to save the country from default. Now, the markets seem to be ignoring these facts mostly so far, but as I always say, markets are not perfect. They are not all-seeing and all-knowing entities. They are not at all omniscient. They are merely an aggregate of their participants, and those participants make mistakes constantly. Let's not forget that the market predicted that quantitative easing would never cause inflation in the first place. Then it predicted that the inflation that it did cause would top out at 4 or 5% in the US, and then it predicted that the Federal Reserve would not hike rates at all in 2022. Now it's just making another prediction about the UK, which I do think is likely going to be mostly accurate. The problem is its predictions based on American and European futures are far, far off. But what will actually happen to the UK then? Well, inflation is not over at all, but there is a silver lining. Inflation in the UK, like in Europe, was heavily impacted by the energy price spike after the Russian invasion of Ukraine. That impact to consumers can actually be fought by government policy by putting temporary price caps into place, which the UK is doing. Now, this doesn't actually stop gas prices from being as high as they are, and these high prices still have to be paid. It's just now paid for by debt that the government has taken out, and that will slowly be repaid in the form of taxpayer income over the coming decades. This should, though, reduce upward pressure on inflation and stop it from rising in the short term. There's also some relatively good data about the British economy. GDP figures have just been revised from last quarter, showing that actually the economy is still growing and not in a recession yet, as we earlier thought. That is, though, where the good news mostly ends, unfortunately. My fear, and the fear of the markets, is that the underlying inflation that existed before Russia invaded Ukraine is a fact, and it's actually very important. The British government is reducing taxes, meaning more money in people's pockets, and that should be a good thing, right? Well, that also means more buying pressure, more demand, and more inflationary pressures. The British government is also not reducing government spending as it reduces this taxation. Now, if they had slashed their spending, an argument could be made that the total demand wouldn't change, it would just change who actually gets to spend it. That is not the case here, though. These inflationary pressures will do two big things that will both increase the cost of debt. Firstly, they will drive the Bank of England to raise interest rates to slow the economy down. This has an instant impact on all forms of debt, on credit cards, mortgages, car loans, because they're all set in accordance with the Bank of England's base rate. The second thing that will happen is investors will then demand higher yields on debts to make up for higher inflation. This means the cost of borrowing will soar for businesses. And that means the crisis point we had last week with pension funds in the UK almost collapsing overnight is probably going to come back. The problems there still exist and yields will rise once more, bringing them to a tipping point again. This is very worrying to say the least, and without a doubt, this story will not end here. The thing about this story, though, is that when you read about it on mainstream media, they will not give you the whole picture because it's just so ridiculously complex. The focus right now is on the new Prime Minister Truss's disastrous plans, and to be clear, I do think they are disastrous. The crazy thing is, had this been done in 2018 or maybe in a few years when inflation is over, I would love these plans. It's exactly the plan needed to drive growth for the country, reduce taxes, attract talent and investment, and prosper. It's a tale as old as time. It's just that this is happening at the worst possible point in the last 40 years when inflation is sky high. Now, it's also worth noting that Truss's plans are adding fuel to the fire, but they didn't actually start the fire. The fire started post the 2008 crash when quantitative easing first kicked off. It then exploded in 2020 with government policy regarding the COVID pandemic, and then it had a can of gasoline thrown on it when Russia invaded Ukraine. Now, Liz Truss has decided to throw her lawn furniture on top of the flames as well. She is not the root cause of this crisis, but she is without a doubt making it worse.